So hello, everyone who tuned into this very brief, very simple market making introduction. Um, I've shared a link in this chat to the Notion doc, and then when we post this on YouTube, or wherever we post this, this will be a link to the Notion doc that kind of covers these things more in detail. But let's just kind of get started. Let me share screen. The host disabled participant screen sharing.
There you go.
All right. Okay. Uh, can everyone see this? Yeah, I'm guessing good. You just nod. I see like a few people on the side here. Okay, cool. Um, so so yeah, let's start with um, market making. How do market makers kind of provide value? I think I want to start with this because I remember, oh man, the first time I like built anything useful, or I built this algorithmic trading bot, and it's like in the basement of my parents' house, and it's just like really late, 2 a.m., and I go show my dad, the machine ticking away, making trades, and just the whole mechanical aspect of it was so exciting, and all the money flowing back and forth was so exciting. Um, and then his answer, his question was like, "This is good, but like, how do you provide any value? Like, have you done anything useful?" And this was just so, oh man, it was so soul crushing to me. So I like spent a lot of time thinking about how do market makers provide value, and I think we should start with that because I think it is a good way, actually, like as a meta principle, as a general algorithm of how to think about trading strategies. Um, so the question of how do, well, traders in general provide value. The way I see it is you have you have regular traders, like say, like, I don't know if Marco Polo was a trader, but we'll just, for the sake of argument, assume Marco Polo was a trader. He traveled on the Silk Road, and you have these traders. They transfer value across time and space, right? They take like spices from a place that has a lot of spices, and they bring it to a place that has a lot of demand for spices, and they take on that risk by holding that inventory, and then they profit from it. Um, and basically, long story short, I think market makers do something similar, except instead of transferring, they're not transferring across space so much. Maybe you could think of it as a transferring value across cyberspace, right? If you transfer from like if you're market making across FTX or Serum DEX and Mango markets, that's maybe cyberspace. But they're transferring mainly across time, and they're holding this risk across time. They're transferring value from a place of, from a time of high supply, low demand, to a place of high demand, low supply, right? Buy low, sell high, and that's the service that you provide, because people want to transact as much as they want, whenever they want, and wherever they want. And market makers are going to provide that service. So that out of the way, like, hopefully you're doing useful things on Mango markets, and probably if you're making a profit, you probably are. So yeah, so there's a lot of different ways to do market making and trading strategies in general. They kind of like blend in together at a certain stage. But there's kind of like two. Well, let me before I get into this, let me preface. I'm like the most savage trader there is, as in I have no institutional knowledge. It's just all like books, articles, trading for 5 years. It, living through the markets. Um, so I get a lot. Some of these names that I come up with may not be like what you learned at I don't know, Alameda or Jane Street or wherever. But yeah, that out of the way. The way I see it is there's kind of two like basic market making things, and I say basic. I mean still reasonably difficult to implement, but the strategies are very simple. And then you can just kind of build on top of them. So the first one is fair value market making, right? Like, and this one can get arbitrarily complex, but the idea is you have some model of fair value. What's the price of BTC USD? Well, you might just go look at, the Serum Dex or the order book, and just say it's the mid price, right? Or it could be as simple as a moving average that's kind of taking into account the last 30 seconds or 30 minutes, depending on your time frame that you want to hold. And you have a model of fair value, and this, I'm hesitant to even use the word model. It's like the dumbest possible thing you could think of, right? Just some idea of what's fair value, and probably starting off with the mid price is actually not that bad. And then you charge a spread, right? And I call this charging a spread because going back to our traders transferring value across time, you are providing the service of instant liquidity for someone to be able to transact with you instantly, and you're going to charge just like any professional charges for their services. You're going to charge some price, and so there's a fair value, but you can't give people a fair value. You have to give them you have to give them some price that is higher than the fair value. And ideally, this price is going to be it's going to be dynamic. You're going to adjust it, right? And honestly, though, in the initial days of Mango markets, I think you could probably even get away with not even adjusting this spread, the spread around fair value. But if you are going to adjust around spread around fair value, you want it to be some like uncertainty that you have. So if the price is moving around a lot, right, like a measure of volatility, then you widen your quotes. So it can be, simple as something like this. You have the mean, right? That's your fair value, and then plus you quote the bid like this. Mean minus the charge, and then you quote the ask like mean plus the charge. And the charge is some function of volatility. Let's say standard deviation, even just to make it like more concrete as one measure of volatility. Right. So this is like pretty basic stuff. And we actually have there's a person on the call right now who was one of my partners when we were market making. Who, yeah, I'll introduce later, but this would be familiar to him. This language that I've come up with. So the other part of this is the inventory management. So, okay, so you have these prices, and for some reason you just keep getting hit on the bid, right? So you just keep accumulating a long position. You just have first you're up 1 Bitcoin, then 2 Bitcoin, then 3, 4. You might start to think at that point that, well, maybe there's something you don't know, or yeah, maybe there's some like your risk is definitely going up because as you keep getting hit on the downside, the price keeps going down, so you keep losing money, and you hope that it'll revert. It'll revert back to your mean, but maybe it never does. You just keep buying, buying, buying. And this is when you might want to start, well, you should start backing away. Because, well, at some point you're going to run out of dollars to buy, or whatever the quote currency is. You're not going to have any more of it to buy. So you start backing away. And you back away in the opposite direction of your inventory, or in the same direction that the price is going, right? So if you're long, if you start adjusting your fair, okay, you can adjust your fair value down, or you could adjust your prices down. Just keep backing down. And you probably also want to like be more aggressive, aggressive as it gets substantial. Yeah. And how do you know that this is going to work? Well, I think if you start off with the assumption, well, if you start off with, okay, what is the service that I'm providing to people? You know, the vast majority of people just want to transact immediately, and they're willing to pay you a fee for that service. Then you might start off saying, okay, well, I'm providing a service, then I should probably, you know, I'm going to be getting compensated for it. But yeah, what if there are competitors who are providing better service, or what if there's this, you know, adverse selection where you're not just trading against people who want your service, which is you know, providing liquidity, but they actually also know something. You know, they're not like buying and holding Bitcoin in the long term. They know something very specific that happened like in the last second, and you know, you don't know that thing because you're just a market maker. Well, I think that's why you would need to backtest. Well, you need to verify with historical data somehow. And backtesting is one way to do it. It's a simple way. It doesn't require very complex mathematics. All it requires is, you know, historical data, good, well, decent, I'll say, decent historical data, and a backtesting environment. And you know, I've built several versions of a backtesting environment that tries to mimic actual real life trading. But you can, there's open source stuff here. I might even, if I get the time, like open source the stuff that I have, although it'll be very, not sure it'll be very relevant to trading on Mango. Right, so yeah, you do this, and then this might give you a sense of the P&L involved. You might adjust these parameters over backtest. But honestly, though, I say be careful. I mean, like, backtests are always wrong. I mean, models, I mean, there's this thing, all models are wrong, but some look good naked. Backtests don't even look good naked. They're just wrong. There's nothing redeeming about backtests. Well, there's redeeming about backtests, but you know, they're just wrong. And so don't be fooled. Like, it's very easy to be fooled by backtest. You have to have a lot of data hygiene, and like if you studied some data science, I think that really helps here. But my whole point is, I think you can get away with not even doing backtest, right? I think the simpler the market is, and the more early stages the market is, I think you can just get away with kind of tweaking it live, and yeah, going with it that way. But yeah, I just want to reiterate, backtests are always wrong. I hear someone say no. So yeah, we'll have a question and answer session. We can debate about whether backtests are always wrong, but you know, I will maintain to the death backtests are always wrong. But they're so useful. They're very useful, but always wrong. So okay, so the other kind of strategy, and I think this one's even simpler, but maybe it requires more. I think this one requires more logistical kind of, yeah, logistical / technical skills. But overall, it's simpler. All things considered, simpler. So what do you do? So you know, when Mango Markets perps goes live, the strategy that you can have, you know, no backtest necessary, anything at all. You quote the bid on Mango, like let's say Mango Markets has BTC USD perp. You quote the bid on the perps based on the BTC USDC bid on Serum DEX. Like, you know, just I recognize sometimes I need to be even more explicit. So if it's like Serum DEX bid is 50,000, then you would quote on Mango perps, let's call it merps bid. You would quote 50,000 minus fees minus some charge minus yeah, maybe, yeah, some charge, right? Like it can be some arbitrarily complex function. See, whatever. Okay. And the idea is that as soon as you are filled on MERP's bid, you sell on Serum Dex. So this is this is like pretty straightforward, right? It's it's that's why I call it RB. It's like almost ARB. You buy on MERPs at a slightly lower price, and then you sell it on Serum Dex and you make this profit. The difficulty though is you have, it's so simple. Eventually, not immediately, but eventually there's going to be other people doing it, and they're going to be doing it probably faster than you. And so you can't just do it and just like put your feet up and lay back and say, I'm done. I recommend everyone do this kind of strategy on day one, but you have to keep improving, because if someone is slightly faster than you, then and say Serum Dex bid changes, right? They will change their quote a little bit faster, and then you will be the one stuck at the top, buying that bid. And now let's say Serum Dex is now like, these numbers are unrealistic, but let's say it's 49K. And now you bought MERP's bid at, I don't know, 49.9K. And now you just lost like $900 because you weren't fast enough. So again, it's much more technically or technologically and logistically important. So yeah, the logistics part's also important here. Let's say on MERPs, it's just going one direction, right? You keep getting hit on the bid. Now you have to start considering, if you're super long on Mango MERPs, and you're on, you're super short on Serum Dex. Maybe you're not even short. Maybe you just ran out of inventory, right? Maybe it's just the pure spot market. You have to find a way to balance those things out. And again, you're a trader, so you're providing value by balancing supply and demand. And that's part of the core crucial function here. It's like people want to sell on MERPs and they want to buy on Serum Dex. So it's your job to figure out how to do this trade, do these trades, but then if you want to keep doing them, you need to balance them back out. That can get complex if, okay, we're going to design MERPs so that this is super easy to do. We're going to combine, and that's why, for me, the design, I went with the design choice of have the spot market cross-margined with the perps market. But the best liquidity is going to be on these centralized exchanges. And then if you get unbalanced across from the centralized exchange to on-chain, that's a little bit more cumbersome, because now you have to wait for those centralized exchanges to allow you to withdraw or whatever it is. So that can get complex. But I don't, the initial strategy is not super complex as long as you figure out this balancing out part. Yeah, so I didn't want to fill in all the details. I think there are actually some people in the chat who are pretty good at, we might add more signals here, and we might add more details based on, what's happening. But some common signals, and this is like, this would go into fair value kind of strategy. It's like, okay, so you might have the very simple idea here. It's like, this is your mean, right? Well, okay, let's even call it fair value. because fair value might not have anything to do with mean. But you have this fair value. So there are other.
That's not your tag. It's not your term.
Oh, I think someone's speaking. Okay, please mute yourself. Just until the Q&A session. It's a little bit distracting. So that you can have these signals like order book average, super common. I'm not telling you anything that's like, I don't know. I don't even know anything very secret. This is all of this stuff is actually super basic and like well known. Order book average is just you sum up the bids and sum up the asks. Hold on. And then you divide by the inverse, right? You sum up the bids and weight inversely. I'll get the formula. This is. I don't want to do this live, but you weight them inversely. Basically, the more bids there are, the more you want to increase your price up, and the more asks there are, or the more volume there is on the ask side, the more you want to weight your you adjust your fair value down. Kind of straightforward, simple, right? Like there's a lot of people bidding. Okay, maybe price is less likely to go down. This is one of the reasons why people like beware of spoofers. Yeah, this is because it's kind of easy to game. Keep a running tally of buys minus sells over some time t, right? So if you have a lot of buys over the last, like, let's say 30 seconds, there's some indication that it would it's almost a tally of market maker positions, because now other market makers are now short because they've had to be on the other side of it. They've had to sell because people are buying, so the makers are the ones selling, and so this has some correlation. These are not very strong correlations either. Has some correlation with the price continuing to move in the next like certain period. And then we have EMA. I think everyone knows EMA, right? EMA, I don't know, just look it up. And then you can have a standard deviation on an EMA. That's kind of this idea up here, right? And you got funding rates. This is an interesting one because this will be relevant for what Mango Markets is doing. We kind of want people like the whole point of the funding rates are to keep the prices in line. It's trading the synthetic contract that is supposed to mimic the spot market, mimic the price of BTC or whatever asset in the actual physical spot market. And so the funding rates go up when there's too many longs. There's too many people buying on the MERPs, then the funding rate is going to be high. And so obviously a very simple strategy there is to sell. Yeah, this is again like ARB, funding rate ARB. Sell if funding rate high, sell perps, buy spot on margin, and then caveat profit here is perps funding rate minus spot USDC interest rate. And in theory, these should in theory, if people are running this ARB, then the spot margin interest rate should be equal to the perps funding rate, or probably, you know, also in theory slightly less, because the perps funding rate is variable and changes more frequently. Well, actually, no, yeah, in our case, maybe not. In our case, the margin interest rates also change, so who knows? And then there's a bunch of other signals, and like David's here, one of my partners from when I was market making. We have like a ton of just random ideas. Just it's almost become spaghetti code, you know. So many ideas that we back tested and modeled and tested on data, this and that, and each idea with its own parameters that we've tweaked. And then there's many more ideas that we never even got to because I never found a way to make them work. And even if you do make them work, financial time series are very difficult because they're reflexive. Well, they have this negative feedback loop where if something works, then it stops working because people arbitrage it away, and then the distribution just keeps changing. And so it's, you know, like I got started in trading thinking, all right, I like make a money machine, make $1 trillion, retire, and it's game over. But yeah, the problem is you become your own enemy at that. If you actually make a good strategy, if you have a good strategy, then you crowd out, you keep your pile of money keeps growing until you take away that entire inefficiency. And again, important to go back to our idea of how do traders provide value. Someone's paying you, like if you're making money, someone's paying you to do something, and they're not going to be paying you infinite dollars. It doesn't just scale that way. They're paying you there's a fixed pot of money there, and you can grab that fixed pot of money, and then the thing goes away. And yeah, that's the challenge. And that's why, and you have competition and all that. And so, yeah, you have to keep finding more strategies and tweaking them and so forth. These are some good books I found. Some people don't, I don't know, kind of, they say they're like, oh, Ernest Chan is not a real trader, or that's not real. Everyone has good things to say about Prado, by the way. But I found Ernie Chan's book like useful to help me get started. It was great. And some links, and yeah, people can recommend other links because I know we have other traders on here. So why should you market make on Mango? Yeah, well, I mean, to be honest with you, the initial days, you probably won't make much, right? So if you're thinking like, well, there's not going to be that much trading volume there. Well, we don't know. We don't know. Hopefully, you know, Nick can do all the hyping and get all the trading volume in there. But likely initially it won't, you know, there won't be the trading volume there is on Binance. And we're still working through liquidity incentives. You know, we have some issues there. You can't have negative fees, right? That can become very problematic. But on the flip side, you also don't have any competition on Mango markets. So you can get away with doing a lot of simple stuff that you simply can't get away with on Binance. And so and you will have this special knowledge of how to market make on chain, which is a very rare skill. And if you believe that trading will move on chain, then you'll be one of the few people who have kind of the real, you know, hard knuckle experience of doing it on chain. And then you'll just make a killing, and that's when you make the $1 trillion right here. And so that's, you know, that's the goal right here. And yeah, oh yeah, and the last thing, yeah, so you get, you know, one cool thing about market making, and one thing that kind of gives me this confidence to work on Mango markets and build Mango markets is I'm just thinking, okay, like, you know, I'm going to do all these calls and I'm gonna try to get market makers and I'm gonna do these things, but oh well, like worst case scenario, I'll just do it myself, right? Like if I want to help make some token have liquidity, then worst case scenario, I'll just do it myself, and that kind of boosts your confidence and increases your power level. So pretty rare privilege reasons to learn how to do this. So yeah, that's my spiel. You know, I think we can do some Q&A. So how do we do Q&A? Did not think about this. People can't really like raise their hand, right?
I have a question.
Yeah.
What's a interesting or non-obvious signal that you found was actually pretty strong?
Interesting or non-obvious signal. I mean, really, the whole thing was very interesting and non-obvious to me. Like the fact that you like, if you go back to college, if you go to economists in college, they will tell you markets are efficient, and so really and then
Yeah.
you might think as a result, okay, markets are efficient, I can't really make a profit there, but maybe if I try super hard and make like a very
Really?
complex
Oh,
algorithm.
it's like one.
Yeah, I don't know who's talking. It's like
I muted him. Don't
okay,
worry.
sweet. Thank you. I'm sure he didn't mean it. I think he was just yeah. So it's all kind of non-obvious. It's, you know, you may think it has to be super complex and whatnot, but these simple strategies really do work. And like even, you know, you backtest like some technical technical analysis stuff, which always comes with a kind of like chart reading and I was never much of it. Just felt like, you know, reading tea leaves kind of, but some of that stuff does work. Like Bollinger Bands, for example, that's basically this idea, right? That's all this is. If you've heard of Bollinger Bands and all these like technical traders, if you just do Bollinger Bands and you backtest it, it won't work. You have to be smarter about it and yeah, like adjust the parameters. But the basic concept does work. So yeah, if that answers the question, it's all kind of non-obvious and really surprising to me. Like, I don't know, does anyone have any questions about?
I've got one. What do you think will be the typical frequency of updating orders on the order book for market making on Mango?
Oh, wow. Let's see. Frequency of updating orders. This is kind of a design choice that we have to make. You know, well, one thing we could do to make the design, to make that so people don't update orders often, is we could have a large difference between the taker and maker chart fees. And so you see like BitMax, right? They have 7.5 bips, negative is 2.5 bips, maker rebate. It ends up being that a lot of the liquidity is just like at the top of the book, and they don't move it because then they'll lose their price time priority. That's a decision we have to make. Yeah, if we increase the tick size, then again, you know, if your fair value, even if your fair value moves, you might still not move your order. So your order might just still fit inside the same tick value bucket, in the tick size bucket. So frequency of updating, it's hard to say. I think we want to minimize frequency of updating because of on-chain costs and whatnot. All the costs are extremely small on Solana, so it really is kind of negligible. Yeah, I mean, if you look, yeah, I don't know how to answer that question. Maybe we're aiming for like during normal market operation, you should be maybe update once every 10 seconds or something. That's just a rough idea, just off the top of my head. And during volatile market period, I don't know, update as fast as you can, probably. It's just going to be wild, so.
Thanks. Yeah, even the notion of a rough idea of every 10 seconds is good to know. It's useful.
Oh, you know what? Again, like I said, a lot of these strategies blend in together, and so market making is kind of it's very similar to this class of strategies called mean reversion, where if the price goes up during some certain time frame, you're betting on it reverting back to its like long-term mean. But that if you can change that to be arbitrarily long, you can say mean reversion over like 5 hours instead of 5 seconds, right? Or 5 minutes. If you do that, then you can actually kind of, I think you can get away with updating your prices every 5 minutes. In fact, I mean, my first strategies were all, they just updated every 5 minutes. But as a result, you're getting farther away from the market making idea, and you're going to be quoting wider, multiple percentage points away from the middle of the book. So yeah, if you update very slowly, then you have to quote wider. But it's all, there's just this trade-off.
Thank you very much.
Yeah, I had a question about inventory management and delta neutrality, and how you sort of look at, one of the examples you were giving was, buying on Mango Perp and selling on Serum.
Yeah.
But that sort of implies that you have Bitcoin or ETH on Serum, so you have some exposure on Bitcoin and ETH. And so how, yeah, I don't know how, like, because if you have some kind of net crypto exposure in your inventory as a market maker, and you're just picking up pennies around the spread,
Yeah.
but then it starts to go the wrong direction, then you end up losing.
You're setting me up for an easy one, I think. I think, yeah, this is why we have the cross margining for we have the spot markets and the margin borrowing lending pools cross margin with the perps. And so if you want to be delta neutral, and I always like to mention, yeah, maybe delta neutral always assumes USD, but hopefully one day it'll not be assuming USD as the neutral, the numeraire. But you want to be delta neutral. You don't want any crypto exposure. You just deposit USDC into your account, and you simply everything is margin. Everything is on margin. So yeah, you buy the MERPs. That's going to be on margin, and you sell on Serum Dex. You sell the spot. That's also going to be on margin. You just borrow the ETH or borrow the BTC or borrow the SOL. And then you're always delta neutral. Yeah.
Yeah, so that's also on Mango.
Yes,
on top
also
of
on
Serum.
Mango.
Yeah.
Yeah.
A second question about connectivity and and I haven't really made markets on Serum. I think you have,
I have not. No.
Oh, okay. Well, it's so when it comes to centralized exchanges, they have nice APIs, WebSockets that you can just subscribe to rich data streams coming at you. You can hit REST API endpoints in order to create and manage orders and stuff. What's that going to look like on Mango? How easy will it be if you're just like a Python scripter and you want to hook something up into Mango? Do you have to expose your private keys on a server that you're running the bot on? A lot of people wouldn't be very comfortable with that.
Yeah. Well, if you're running it on a server, I think is there a way to not expose? I think you have to expose your private key. Maybe no. I think you have to expose. I mean, it's going to be on the server, the private key. So hopefully you trust the private key or trust the server. I guess worst case scenario, you could run your own server. But in terms of market making, the data feeds. Well, my experience is in making the liquidator. That's as much as my trading experience on Serum Dex goes. And those are fairly reliable, like when you request data from some API endpoint, some validator. But we have found actually, you can make it a little bit more reliable if you get a reliable validator, or like some private connection with some validator who's willing to provide you the node service. And you can also make it a little bit faster that way. They can cache like the specific accounts that you care about and keep your WebSocket connection faster. I haven't used the WebSocket connections in Serum very much, although I don't know if Tyler's on the call, but he's done it when the UI, and there's other people on the call who have Rorden has done it for his own trading, so maybe he's like better able to answer that. I think it's fairly reliable. Yeah.
I think it would make life a lot easier if there was an API provided by Mango that people could just subscribe to the data to get order book updates.
Oh yeah, well, of course we would have. I don't know what you mean by API, because there will be. I mean, there already is for Mango. There is like a client and functions that you can call, and then get these streaming data, or requests, API requests, and like tell you. But none of it. If you mean something more like we have a server, and then that server sends you information, that's always going to be a little bit slower, because that server then it has to get that like information from the validator, because what's on chain is what actually matters. That's the back end, like the chain, the Solana chain is actually the back end. But that might be in the cards, but I'm not sure how much value it would add, really.
Yeah, maybe also a bit of insights here from basically the API we're using, right, to communicate with the chain is also just a REST API. It has some, I would say, wrappers to make it more understandable, because it hasn't been designed specifically for the use case of trading. So it's a very complicated REST API, I would say, like, and it's really like communicating with a blockchain kind of API. So it's not really something intuitive. But there are a bunch of people working on API wrappers. I think one good example is the liquidator. We have one in TypeScript. Jeff, who's also on the call, is building one in Python. And I think a third good example is from there's a data provider, and I'll post a link later, but he wrote a really good scraper for the trades, actually. TARDIS Dev or something like that. He's a data provider, so he sells data, but the adapter for Serum Dex and Mango is open source. So you can have a look there on how to do it, and it's really just a few lines. It's not really complicated, but we can also help you on chat and go more in details after the call.
Yeah, we do want to make it easy. Yeah, that's and there are people who are building. Like you said, Jeff is building the Python API, because a lot of traders are familiar with Python, and so building a Python API. But we'll have like a JavaScript API. Yeah. Any further? I don't know. Book recommendations, strategies.
Yeah, I
Yeah.
recommend strongly from J.P. Bouchot, this French physicist that's written a bunch on this, but Trades, Quotes, and Prices is one of the books he's written, which is really good. But a lot of his stuff is good in general.
That sounds like what's his name?
Bouchot, Bouchaud, yeah. AUD, yeah.
Okay.
So you mentioned a bit about fees and liquidity incentives. I guess it's too early to ask about specifics because that's going to change the calculus of the market making dramatically if there's some kind of incentives that are being, like Mango tokens are given just for people maintaining an order book presence, not even necessarily like getting hit, but just being close to the front of the book, which is, I guess, what we're most interested in. And rewarding people. You could take one suggestion, I don't know if this is the right forum to mention it, but one suggestion I would say is take snapshots at randomized points every minute to see who's in the book, and then just average that across the day, and then allocate some amount with a exponential weighting from closest to the book gets closer to the top of the book gets weighted the most, and the further out gets weighted the least. And then you just distribute rewards to people just for having a presence.
Distance to mid of the book. Okay. Just being on the book. Yeah, that's probably the best way to do it. Yeah, we were thinking about even like distributing Mango tokens to on the maker side, but basically, yeah, the thing you run into always with distributing based on volume or actual trades is you have this bound that it can't be negative, and because if it's negative, then people will just wash trade with themselves and drain the account.
Yeah, no, that's not good.
Yeah. But this is a good one. This would require some setup, and there's some preference for, I think, decentralized mechanisms. But yeah, I think we're fine with implementing this too. Yeah.
Yeah, this was, I think, also recommended by Sam from FTX. He also recommended it. Seems to be like a fairly proven way.
Yeah. Well, you can always verify the truth of these snapshots, right? You can always say, like, on this slot number, this was the state of the order book, and these were the people who, these were the accounts that had these orders on the order book. And so it's always verifiable. So you can't be like cheated in that way. But yeah,
Is it not gameable though? I mean, the incentives are just for being on the book, and could I not buy and sell one Bitcoin at 0.5% spread above and below, so I'd be on the book, but I'd be terrified of any order being hit, so I'd be replacing that every 5 seconds or every 1 second. I'd always be on the book. I'd never want the order to be hit, and I'd just be taking the incentives that you're talking about.
Yeah, I think if you did that, you would just we wouldn't. The formula here, the exponential weighting, wouldn't reward people who are too far from the center of the book, but also you would get. I think it should probably be weighted by in comparison to others. So there's like a fixed amount of Mango that's going to be distributed, and the best people, the people closer to the top of the book, and the guy who's literally at the top of the book will get the lion's share. And if you're always doing this 1 + 1 + -1, you might find yourself outbid often, and therefore not getting much Mango. Yeah. I don't know if Swamp Man wanted to.
Yeah, that was, I mean, I guess the comment I was going to make is that good. Hopefully people do game it, because that means that they're providing solid, tight liquidity consistently. And that's a good game that we want to have people playing.
Yeah, and BTC does move more than 1% sometimes. So
Yeah.
yeah.
I think there's one thing. Oh yeah, go ahead.
Yeah, I was just going to say, I was just thinking about the economics of, I know everyone on Solana is always saying, well, yeah, transactions are basically free. But at some order of magnitude, they're not free. And I'm just curious about if anyone's done any back in the napkin maths around the economics of repricing every 5 seconds on, 5 price levels, and how that sort of looks day to day in terms of how material is that cost for someone on a market making scale.
Yeah, I wonder. Well, so far I have just rounded that number. I think it's like this 0.00005 Sol. I mean, it's such a small number that I always round it to 0. But if Sol goes to $1,000, or when Sol goes to $1,000, it might be more substantial. But I haven't done any back of the envelope calculations on it yet. I think it is close to 0 right now. If it becomes more, we might have to increase the tick size on the books, which adds a little bit of inefficiency for sure. So yeah, if you, just to explain, if you have a larger tick size, like with tick size being like the minimum increment that you can change the price, you won't have to change your price very often, because you can't, even if your fair value, so like if the tick size is on BTC $10, right? You could quote at 50K, or you could quote at 50K plus 10, 50,000 $10. But if your fair value is like fluctuating between 50,000 and 50,000 and 20, it won't be, you won't move up to the next tick size. So you won't be cancel replacing very often. So that's why, yeah. So if the price goes up, we have to, I don't know, we have to call Anatoly, ask him to make the price go down, or secondarily increase the tick size. So.
One other thing, so market makers are eventually, like, outside of these incentives, we're making money from flow.
Yes.
And I don't know if that's outside the scope of this call, but what are the plans in terms of incentivizing flow, like the people that are actually coming in and taking this liquidity?
Yeah. Well, I hopefully, yeah, in terms of incentives, we have to think of another, like, I think that fits under this potential liquidity incentives thing, where, like, Max came up with this idea of, you have a fixed amount of Mango tokens that are going to be distributed every day, and it's just going to be distributed pro rata to your volume on Mango. And those kinds of things, well, I don't know if you can't do those things indefinitely. That just doesn't make sense. But it might be one of those things you will do initially to get people to take the switching costs, because they're switching. They have a setup. They trade on FTX. They trade on Binance, or wherever it is. Give them that incentive to switch over. So yeah, so some kind of liquidity incentives there. But yeah, ultimately, I think we'll just have to tell people, I don't know, Twitter. The point is, it should simply be better, right? Like, the fees should be lower and the experience better, that they will come on their own. But we can kind of smooth it over in the initial days with some liquidity, some of these mechanisms, incentive mechanisms. Yeah. Great questions. Swapman is really hyped, I think. He always comes with the most detailed questions and answers as well. He's also filling this out, so the full package.
And so when MERPs?
When MERPs? Yeah, I know. I'm just like gonna keep saying 2 months TM. We're, as you can tell, there's kind of a lot of pieces here. So yeah, 2 months. At least it's not 2 weeks TM. You know, two months is more honest, I think. Yeah.
Are you going to use Anchor?
You know, I started off. So yeah, I don't know. I was thinking about it this morning. Yeah. I just like the bare. I want to do the bare metal. You know. I'd be convinced though if Anchor is sufficiently easy to pick up, then
We've already started looking at, you know, maybe trying to make edit Serum's matching engine, just because we have to build weird stuff on top of it. So maybe a solution for you if you're having trouble building stuff on top of Serum's matching engine, that you could just sort of edit it yourself.
Well, I don't know what you mean by edit yourself. For sure, we are going to have our own order book because it's not going to be an SPL token that can be traded on Serum Dex. And also like the Serum Dex fees don't make a lot of sense when there's a lot of leverage, right? The 22 bips fees and stuff. So we'll have to build our own order book. It's going to be inspired by Serum Dex, as in like inspired as in, for the most part, Serum Dex order book. But it has to be part of like integrated with the Mango, yeah, the whole Mango contract. Yeah, so I don't know if that answers your question.
Oh yeah, no, totally.
Yeah.
I'll be in touch.
I think one thing you kind of, you know, didn't fully go through in your notes. Actually, I spotted one thing that, I think it's the last point, right? Like, and it's kind of like, right, like we're going to start with a PTC perp because it's kind of the thing that everyone can provide liquidity on, right? And like we'll understand what it is a bit. And there's also a good spot market to work with. But yeah, the special thing about DeFi, right, is like you can roll your own market. And the only thing that can stop you from it is like figuring, like if there's liquidity for it. But as a market maker, there's this, I would say, very special position here that technically you guys can like decide what goes live next, right? If you think you wanna provide a market, you want to make it alone, you just launch it. We can put it in the UI hopefully, and people can use it.
Yeah.
And so it's a bit like, I would say, direction also coming in, right? Like we're a bit like, yeah, we're excited to see what you guys want to trade and what you want to offer to the users, right? And so this is more, I think, more symbiosis than maybe it seems like in the beginning look. That's also why we're doing the session, like, you know, trying to excite people for the idea, but also people who are already there. And I think, yeah, Swamp, you certainly know your shit. So it's about like working together on this, right? Like the one can't exist without the other, and we're making sure that like the UI is good and the matching engine works. But we want that it works in the end, right? And we understand market making is such a crucial piece. It's just also something that's maybe not best done open source, right? Like I think there's a potential for open source market making, but there will be certain strategies that people don't want to reveal, maybe. That they want to, right? That they spend a lot of time on, and it's maybe not in the ethos. And so we see that there's a lot of benefit for people to be closed source, and that's just not what we're doing. So our hope always is, of course, to make you convert in the long term. But in the short term, it's certainly what's going on. So we're excited to work with groups of people and give as much support as we can.
Yeah, I would add with regards to this, like market making as a business thing, is that you could run a market maker that people invest in, and then you share the profits of it too, right? So it doesn't necessarily have to be open source in that regard. You can just set it up in such a way where it's running and it's maybe every week collecting the profits and distributing it to those that have invested. But I have a question actually about this launching own markets.
Yeah.
So there's this insurance fund that's going to be funded by the public, right?
Mm-hmm.
And when the first thing I thought when I saw this was, oh, cool, I can create a market that is super illiquid, and I can game the insurance fund somehow and steal money from the insurance fund.
See, you didn't refer to this. You start with the opposite. You don't think, how do I provide value? How do I extract it? Anyway, that's good. We need people like that. Anyway, continue.
Yeah, I'm not evil, but
Yeah.
I think
No,
way
that is
to
highly
stop the
valuable.
evil people.
Yeah.
So basically, I guess what I'm saying is that this insurance fund is something that should serve to protect the integrity of Mango markets.
Yeah.
And like, we shouldn't just let it be used for any markets that are getting spun up by any random person. Like, that needs to be carefully guarded in many ways, and making sure that it's like serving its purpose.
Yeah, I mean, managing the insurance. I mean, the insurance fund really is just the DAO treasury, right? And so, Mango token holders have to like safeguard it, and obviously, we're in that initial position of making sure we safeguard it before we get the DAO launched. So, it can't just be you can't just arbitrarily hook into the insurance fund. There's got to be, initially it's gonna be consult with us, and then after that it's gonna have to be like a formal DAO proposal. But that doesn't mean, well, when the code is open source, it means you can probably fund it with your own insurance fund, or not have an insurance fund at all. That is kind of going to be your prerogative. And I think likely, say someone wants to launch a market that they care about. I'm not sure we can support this on day one, but just like, we're not even at MERPS version 1, but we're talking about MERPS version 2. But MERPS version 2, you should be able to say launch a market on Tesla, Tesla USD, or whatever it is, like the rent in San Francisco. I think Anatoly wanted that, so someone needs to please make that happen. And in those cases, obviously you would have to provide the liquidity and also have to provide the insurance fund, or not providing the insurance fund at all. But I mean,
I guess there would need to be a valid oracle to mark the fair value for liquidation purposes and such, right? Like, this framework is not just for crypto, perpetuals. It's anything perpetuals, right? But like you mentioned, Tesla, it can be prediction markets on whatever, but there needs to be some anchor for fair value in terms of determining liquidations and such.
I mean, that's why I think the person who develops this thing has to, or the person who launches any kind of new market has to kind of take those risks into account, and they have to internalize those risks. Like, for example, one of the design choices that we have to make is how much leverage to offer, and how much to punish people who get liquidated, because, well, people who get liquidated are I don't want to say irresponsible. Maybe they're very responsible, but they are putting the insurance fund at risk, because they had a position that went out of line. They had a position that went almost to zero, and somebody had to take them out of that position. They didn't do it themselves. And if nobody took them out of that position, then they would impose losses. And if nobody can take them out of their position in time, they impose losses on the insurance fund. So there is always that, like, the insurance fund is the DAO treasury, and we have to safeguard it with our lives. and we have to sacrifice irresponsible traders if we must. But insurance fund above all. So. Yeah, I think we can probably conclude.